Hey, Yan. So we're live.
Perfect. My sharing is paused. Can you see my screen now?
Yes, I can see your screen is showing the cover page.
Right. Let me see whether it can go to the next one. Can you see it's the next one?
Yes. Yeah.
Okay. It's interesting. Why it says the screen sharing is paused? No idea. Okay. So can you text me the phone number and then the meeting ID in case we get disconnected?
Yeah, let me work on that. See Seema's joining us. Hi, Seema.
Hi, Sima.
Hello.
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 So you're back to Miami. Is it Miami?
No.
Or?
I am in Sarasota and I'm just being hit by the hurricane they had been talking about.
Oh, that's bad.
I came back just in time from New York to get some nice rain.
in New York, it's the same thing. I just had a huge thunderstorm here.
Oh, did they? Okay.
Well, for like a very short time, I think 2 hours ago. So I was concerned that my network connection might not be good.
Okay. Oh.
Yeah, but so far so good. Yeah.
Okay, good.
Yeah, we had a heat wave just a week ago.
Yeah, I know.
I mean,
Yeah.
I'm up in Seattle, and it's just terrible.
So how high it is?
It went up all the way to 110 degrees.
Oh my God! To you guys, it's like a record high. Is that right?
It was a record, definitely. Never been that hot in my whole life. Well, I guess maybe not counting the days when I was in China, but we at least had AC, but not here.
Oh, okay.
We never had to because maybe as high it could get is maybe few days in 90s.
Yeah. All right. Yeah.
All right. So Grace joined us too. Hi, Grace.
Hello, Grace. Nice to have you on. Yeah. So today is really just very free form chatting. So feel free to ask me any questions you have about this ATM deal. If you don't have anything, there's another form that over the months we talk to a lot of investors. They ask us all kinds of weird questions. So we document it and then compile into different modules. So that way, whatever questions you come up, hopefully show up before, then we can just talk about it. Hello, Bean.
Yeah, I'll say Bin and Chris just joined us as well.
Oh, nice.
Okay. And we are also live on Facebook. All right. So yeah. Maybe you think we can get started? It's 3 minutes after 5. So all right. Well, welcome everyone. So we, like Yan just said, we launched the ATM fund about in March, and it's been a good success. And we have getting quite a bit positive feedback and also questions from our investors. So we want to take this opportunity just to share kind of, or maybe just have a live Q&A session to discuss. If you have any question, we can answer. Or we also prepare some, a lot of times we have getting the same questions, so we prepare certain slides that speak to that. But our goal is just a pretty informal chat, to keep it within an hour. And I know some of you are in East Coast, it's getting late, so why don't we get started? Okay. So yeah, just real quick, since we are raising capital, so we don't throw up a disclaimer up here. So again, it's just legal housekeeping. We're not investment advisors and always do a due diligence. And private equity is illiquid, so there's always some degree of risk. So you just have to, they're outlined in the PPM documents. And again, what we have tonight is live Q&A sessions. And this opportunity is a 506C offering for accredited investor only. And we'll talk about what accredited investor are if you're curious. And if you're a sophisticated investor, you're welcome to stay with us and listen. and we provide a recording at the end of the webinar. And if we go too quickly, or we just always tell us to go back, or we also show the recording as well. So if that's said, why don't we go to the next chart, which is just introduction. So I think pretty much you know Yan, or probably heard about me already. So we'll keep it very brief. So I've been investing in real estate probably for the last 9 years. I still also have a W-2 employee as a project engineer at one of the aerospace company. Just I've been investing mostly in single family, but just this year we closed on a 24-unit apartment complex in Phoenix. I'm a sponsor working on that deal, and had the pleasure working with Yan together on this ATM fund and our Sharpe investor group. So it's been a great learning experience. So I kind of can compare and relate what it is to dealing with troubled tenants. I do property management, all of that, comparing to investing in an institutional grade company or fund. It's definitely a breath of fresh air for me. So I've always been enjoy working in a group. So with that, I'll turn it over to Yan.
Hi, everyone. This is Yan. Some people already know me, but I just want to point out a few things that make me probably different from other people that you met. One is that I still have a W-2 job. My W-2 job is actually a market risk manager at a quantitative hedge fund. So what we do, we use statistical model to project the return of the securities. So that data analysis and also the risk management and also the portfolio management skills, I found it very, very useful in my personal real estate investing. And I also found this is my advantage because real estate industry still is a lot of driven by relationship. The data analysis is not fully utilized. So I think this is our niche. And then also one thing that makes Sharpe Investor Group unique is that we are talking about a co-investing model, meaning that we put our own capital in. A deal can only go through our standard. We are willing to put our money in, then we will bring to the investors. Why we want to bring to the investors? Because we believe that together as an investor group, then we can negotiate a better term. It can be, okay, maybe the preferred return is slightly higher than you personally invest. Or it can be maybe lower minimum investment, or it can be if you are individual investors, you probably cannot get into a deal, but together, because we pool large amount of capital, then we can get into the deal. So either way, you will benefit from being part of this co-investing group. And our interests are completely aligned because we are just one of you. My $100 is the same as your $100. So that's a short introduction. And I want to show you guys the YouTube page and the Facebook page we recently created. Actually, let me just show this one. Let me know whether you can see it.
Yeah, we can see it.
Okay.
We have to zoom out a little bit. There you go.
Yeah. So this Sharpe Investor Group. So if you go to YouTube, you just search Sharpe Investors, and then on this homepage, you will see different playlists, right? So we want to make it easy for everybody. So let me walk you through what are the playlists that we have. For example, we have the current investment opportunities. So everything related to this ATM deal will go underneath this one. And then we also, last year, we did a lot of specific topic deep dive. Each one is more than an hour, right? So we have a lot of topic here. And then we also interview the professionals in this space, and they give us a lot of tips. And recently we started implementing this Smarter in 3 Minutes video. Basically every week we send out something that I think maybe it's an aha moment for me, and then I want to share with people, or sometimes it's explaining one concept and how does that apply to real estate investing. And then last year we did a lot of like market updates because it's COVID, right? So we update very, very frequently. And then, yeah, you can explore around to see whether you like it or not, and then subscribe and then give us some feedback. Similarly, here we have our Facebook page recently created. So the content are pretty much the same, but most importantly, here you have this social function, right? So you can ask any questions, we can answer, you can also connect with other like-minded passive investors. I think this is really, really important. Yep, so that's what I want to share. Okay, so now let's go back to.
Yeah, so I guess the format today, I mean, go ahead. Actually, I'll let Yan finish the thought.
No, please go ahead.
Okay, so yeah, I just wanted to share we're not necessarily doing a presentation like we did in the past. This is really try to get engagement, and also if you have any questions, just you can raise your hand. I think there's a button in the bottom, raise your hand, and then I can call you out, and you can ask your question, or if you want to type, you can also use a Q&A box. Either way, I'll try to moderate and let you have the ball. But only if it's quiet, then we can go through some of the very frequently asked questions that we prepare beforehand. So with that said, anyone like to ask us any questions? I think they just wanted to hear you talk, Yan. So
no, sometimes people are very, very shy. So yeah. So I will first start with showing you all these 6 modules that the frequent question that people ask. And if you are interested in any of it, you say, hey, I just want to hear this question, and then give me the answer. Then I can stop there. But I will just first list out all the questions that people asked us in the past. So we bucket it into 6 buckets, right? So first, start with the ATM industry. So without understand the whole industry, you cannot analyze this specific deal. The reason is because people have so many misunderstanding, misconception about this ATM business. The common misunderstanding is that, okay, cash is dying and technology will kill it, right? So is it true or not? So today, we don't want to give you our opinion. Our opinion doesn't matter. We give you the real data. The real data speak much, much louder than our opinion, right? So you can give all the hypothesis or theory to explain the data, but it does not change the data, right? So start with the industry. Then, okay, if you're interested in this industry, you think, oh, this industry turns out it's much, much bigger, much, much lucrative than I thought. I want to be part of it. Then how do you be part of it? That's the real key thing, right? So then we will talk about the operator that we pick. So everything you need to know about them, what we like about them, it will be in this session. And then you want to know all the details about the deal, right? So the deal is like the key to decide how much return you can get, what is the risk you're taking, right? So how does that compare to other investment? This is very important. I want to give you a concept of opportunity cost. Imagine that you only have 50K. You can only invest it in one deal. So where do I put my 50K? Right, so you have to compare different asset class, assuming that you only have that 50K. So I compare if you put it into the stock market, if you put it into bond, like buying the 10-year treasury bond, or you put it into multifamily, or you put it into this ATM, and then I calculate various return measures. It really matters. Even for return, there are different ways to measure it, and then also, I calculate the payback period and then the risk. So I will explain all that so that you have an apple-to-apple comparison. If I only have this amount of money, where should I put my money? So lastly, why you want to work with us, we quickly go over that. And then if you are still interested, you want to know the logistic, how do we invest, right? So I will explain that. And then some people, they're curious. They want to know something about the ATM machine itself. So I put it as a backup. So yeah, and then yeah, so probably I can still show you the all the questions that people ask about, like in each session. Then you will tell me which one you want to know. So yeah. So a lot of questions. So this gets a lot of questions like, okay, people want to know, does the demand for cash will continue in the future? Because we are projecting in the future, right? So I want to put this into a long history, and then we can see how cash survive the recession period, COVID period, and inflation period, and then also technology innovation. How does that perform in this period? So that we have a sense when this happens again, how it will perform. And then also a lot of people ask, who use cash? Because we don't use cash, right? So, and where cash are used. And then also, how does that relate to ATM business? And then how big is the business? What are the key players in this space? What are the key factors? So is there any question that interests you in this session? Please feel free to ask questions.
This is Seema. The reason I'm not asking questions is because I had my own private phone call with Yan Yan yesterday when I was in New York City. So you did a great job explaining everything to me. And as I had told you, just because I'm Indian doesn't mean that I know any math. So my numbers are very bad. So I'm not even going to bother, I don't bother to understand that. I just look at, I hear what you say and I look at your comparisons. And for me personally, that is good enough.
Thank you for that. Yeah, so actually, after we invested in this deal, we keep learning, right? So all this presentation, if people attended our March presentation, they will find out a lot of contents are updated. Every month, we are adding a lot more new stuff there. We found more data to see, hey, whether the investment thesis actually gets supported by the real data, right? So yeah, so a lot of contents are new. I just added today. So if people are interested, then we can go ahead. Anyone else? Don't be shy.
Maybe, yeah, you can go ahead and jump into the one. I know you're burning to tell us some story about some of these charts. Why don't you go ahead and take us through one, and maybe it jogs, more questions.
Okay. So yeah. Okay, so this is the data from Fed. So basically, this is going back to 1980. This is the annual growth rate of circulation of cash, right? So that's the demand for cash. So one thing we noticed, this is 0%. So besides 1 month in maybe 2000, it goes below 0%. Every month compared to a year before, it's always circle around like a 5% to 10%. In COVID, it's even 17%. So that's the first thing that we notice is that at any given point here, you will see most of the time, the demand for cash not only is not dying, it's growing, sometimes even like to 10%. So that's one thing to bear in mind. It's very counterintuitive. Just because we don't use cash, it doesn't mean that other people don't use it. And then this is the whole history. But then we can also zoom into a specific period and see how it performed, right? So the gray area are all the financial crisis, right? So those are the recession period. And you can see not only it grows, but also it grows at a higher rate in every recession period. See that? We can come up with all kinds of explanation. Maybe like a research I read, 100 pages, it says people just feel safe to carry cash when crisis happen, right? So, but those are theory. The reality is this is true, right? So, okay, what's the impact to COVID? COVID has huge impact to the demand for cash. It's 17% annualized growth. So those are the high-level data at a industry level, but what is the real data for our fund? So this one, I got it yesterday, and then I put it here. So at the portfolio level, there are two lines. One is, what is the number of transactions for the whole portfolio every month? And then another one is, what is your revenue based on those transaction volume? Because when I explain the business model, you will see the key factor is how many transaction volume you can get, because each transaction you get maybe $2.5 to $3 surcharge. There's nothing to play around there. So a higher volume means higher like a surcharge revenue. So we see that for the past 12 months, the most difficult period in the history, when everybody is locked down at home, you still see that it's not affected and it's growing. So that's why the fund actually never missed any single monthly payment as planned. So they started a fund in 2012, but every single month, the distribution is paid out to investors as they projected.
Hey, yeah, just hold you 1 second. So the background story of this is actual data reporting out of the fund. Is that correct?
Yes. This is our fund. Yes.
So this is the actual portfolio we're investing. These are actual transaction data.
Exactly.
During probably the worst ever time possible for ATM business, and they still did not miss any distribution, right?
Correct.
Okay. Go ahead.
Correct. And then, so this is aggregated over the whole portfolio. And then per ATM here, I also calculated this number and I give you. So each ATM is making this amount of money. And then we can also break it down into two components, right? So, one thing I forgot to mention is that, see here, as we grow, attract more capital, it deploy more ATMs here, right? So you see here, it grows, right? So meaning that when they get the capital from investors, they repeat the same business strategy into new market. They keep growing their portfolio. But does that mean that the quality of the portfolio actually becomes lower? No, actually it's become higher and higher. Because they enter into a new market, it doesn't mean that they've lowered their standard. So we can see it from here. So 492 is per their each ATM in the portfolio, every month they get 492 transactions per month. Compared to industry standard, it's 210. So it's more than 2.4 times of the industry standard. The reason, as I explain later, is because they specifically pick the location that has higher probability of the target population, which is underbanked or unbanked population. So because they have very strict selection criteria, so when they enter more market, you see that actually the per ATM per month transaction volume actually goes up. When we underwrite it, we use 492, but now it's 528. Okay, so here is the surcharge per transaction. As I mentioned, it's industry standard. It's about 2.5 to 3, so it's around that range. Sometimes it's slightly higher. That's why we see that per ATM is actually making a little bit more money compared to a year ago. So this is the real data. You cannot find it anywhere because it's private investment, but I showed it to you just to prove that everything we said about the industry, it's not a hypothesis. We do see that data from the past performance. The fund is still operating and then we keep investing. So yeah. Okay, we also are concerned about the inflation because right now we are in inflation, like the inflation quietly pick up, right? So we are concerned about how does that impact the demand for cash. Long story short, I don't see any relationship. So this is the historical inflation, and this is the historical cash And I don't see any correlation, so we don't have to worry about that. Lastly, a lot of people ask us, what is the technology impact? Is it a threat? It will kill the cash? So again, we want to start with what are the facts, right? So here, using this timeline, I actually line out all the major breakthrough in technology. Let's say, okay, in 1950, introduced the first credit card. In 1983, the first mobile phone was launched. And then also 2009, Bitcoin launch, 2010, Square launch, 2014, Venmo, Google Pay, Zelle. So all these things, people think that they will kill the demand for cash. Turns out, no, because we still see the annual growth rate for cash is around 5% to 10%-ish. We don't see technology is threatening the demand for cash. And we also don't see that for this specific strategy, it will be affected. The reason is because the operator specifically targeted to a subset of population, which is called the unbanked or underbanked population. And they don't have a bank account. So whatever, for example, the digital wallet, you need to have a bank account to benefit from this technology innovation. But if you don't have a bank account, you are isolated from the technology innovation. Also, from mindset perspective, they are probably the slowest population to pick up the technology innovation if they can, right? So that's why it almost feel like they are isolated from this technology shock. So that's the fact here. Of course, we have all kinds of theory to support that. Henry, do you want to go over it, or yeah? How do you feel?
Well, I guess I can just talk one thing. I don't have necessarily to go through everything in detail, but on the chart on the right side, this is the primary method to access bank accounts. The right chart here on the right side, where and it kind of comparing. I know it might be a little fuzzy here on the screen, but the box that I highlighted in the middle is the ATM usage. And then you can see the next one is online banking, and the one over is mobile banking. As you can see, mobile banking is really taking off, as everyone would expect. Everyone using their cell phone to access. But as far as ATM usage, is actually still pretty steady. So I think what we see in there definitely what we call a true. I mean, there could be technology disruption, but mostly to the credit card, or it's more predatory to the plastic than it is to the ATM itself. People are still continue to use ATM due to demographics that Yan mentioned, the unbanked and the underbanked. So, and I feel that maturity for online banking and online payment is definitely getting higher and higher. And even in places like in Asian countries like China, is very mature for online banking and mobile banking or mobile payments. But they're still keeping ATMs because they're always segment of population that maybe could be elderly as well too. And that's another reason that people are not as familiar with the phone, or don't feel it's as secure or as safe as using cash. So there's always a need there, and we're not seeing that going away.
Yeah, that's a very good point. So borrow the experience from other countries, right? So a lot of countries actually want to do the experiment of cashless society. They all ended up, they have to stop, right? So I can tell you, UK done the research, Switzerland, and then also the India. They all try to do that, but they found out that if they force people to live without cash, a large population, they cannot live their life. So that's the whole reason they stopped the program. So in United States, same thing, right? So we heard about this cashless society maybe in 1990s, but now 20 years later, we are still here. And the demand for cash is actually increasing. And then also, I want to highlight that here, there's a chart. this is the regulation, right? So basically in the United States, federal just passed a law to forbidden the retailer do not take the cash, right? So, and then also there are states that forbidden the retailer of doing so because you are discriminating people, right? So yeah, so that's our answer to the technology risk. Again, we think that data matters, fact matters, opinion or theory doesn't matter, right? So, okay. Another thing that the people ask a lot is about who used the cash, right? So we already mentioned that the targeted audience is the underbanked or unbanked people. Unbanked meaning that their income is so low, they cannot even afford to open a bank account. The underbanked is that they have one bank account, but they rely on a lot of alternative funding method. Like they probably go to some like a pawn shop to get the cash or whatever. So the things that we don't usually see, but that's the way that they get cash or whatever. The fraction of these underbanked and unbanked total, it's like 30 million. And this number is pretty stable according to the historical data. So our operators specifically target these demographic. And if you zoom closer, you will see for this underbanked or unbanked people, if you look at their income level, if you look at their education level, you see there's so there's some characteristic about this subgroup. And because this characteristic will not change like within a decade, so you will see that this population will stay for a while. By carefully choosing this target as the customer, we can see that, okay, they will still heavily rely on cash because they have no other ways to get, no other payment method. So, yeah.
Yeah, and also this segment also, sorry, adding to it real quick, is that the segment of population are probably most severely impacted by recession. But it's sad to say, but the worse the economy gets, the probably more of this population. So so it is kind of counter-cyclical, I would say.
Yeah, that's true. That's true. I think in 2008, this population actually increased. So it's, yeah, as you said, it's actually recession resistant because it's counter cycle. Right. Another interesting question that we get is that where's cash used, right? So here is the 2019 research. I think if you live in East Coast, probably a lot of things that sound very familiar, right? So you go to fast food restaurant, coffee shop, that's 23%. They pay by cash. And then grocery store, convenience store, 18%. Gas station, 13%, blah, 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 right? So those locations happen to be the target location that our sponsor choose, right? So their business strategy is carefully designed to target to the underbanked and unbankable people, and they targeted to this location with this characteristic bear in mind, right? So, and also cash, sometimes people just carry it because they feel safe. And the average amount of that carriage is like $60. And then also for small transaction, like below $10, cash is used for 50%. And if it's $10 to $25 transaction, cash is used as 1/3. So those are the places where cash is used. We already talked about this. So again, I think Henry already mentioned that it's very important to understand what is competing with what. You can't be very general saying, hey, technology will kill cash, which is not true. After research, we found out that actually there are two lanes here. So the branch is competing with ATM to fight for the customers who are heavily reliant on cash, right? So these two, here I use an analogy saying that, hey, this is local road, this is highway, because ATM is more convenient, right? So, so those two are competing for this type of customer. But if we are talking about the bankable population, we are talking about here, right? So they use credit card, they use digital wallet. So which two are competing? We are talking about the plastic credit card competing with digital wallet, right? So, but these lane will not compete with these two because, as an analogy shows here, right? So when you have a plane, it doesn't mean that there's no highway, there's no local road. No, they can coexist. It's just digital wallet compete with credit card, and then ATM is competing with branch. And then we already see that ATM increase over the years to replace the branches because it's very costly to open a branch. And it's very convenient to get what you want from the ATM.
So hey Yan, I know we probably can go through this, but I just want to maybe process check any questions from the audience, or maybe we could go to another different topic as well. Maybe we can go into the investment and how it compared to a multifamily type of investment, or be adding this to your portfolio. That's the real question, right? Good.
Yeah, absolutely. Yeah. So first, does anybody have questions that they are just so eager to find out? People are very shy. Okay, if not, then let's see. How do we get to that part? Okay. Not the operator, the deal. Okay. Okay, so investment comparison. It took me a lot of time to try to calculate this. So I put myself in passive investor's shoes to try to come up with the comparison, right? So what if I only have limited capital, then where should I put my money in, especially right now when there are a lot of uncertainty in the market. There may be a lot of bubble because it's late cycle, right? So you want to achieve the right balance for you in terms of risk-adjusted return. Okay, so first thing first, people care about cash flow, right? So there's no bad or good. I just want to show you the difference, and then you can pick the one that works for you. So here are two investments, the same amount, and then I use all these returns like a typical returns for this type of asset, right? So what I projected is here is just different distribution of cash flow, right? So assuming this is all 7-year investment, the blue one is the ATM. So you will see there's a high bar in the first year. The reason I will explain is because it gets great tax benefit. So when you get great tax benefit, it saves you a lot of money to pay to IRS. That's why the first bar, blue bar, is so high. And after that, from year 2 to year 7, it's almost the same. It's kind of like predictable cash flow, but this is not like a bond, because I will show you in return, a bond come nothing close to this one. It's still equity investment. The reason is because we are getting this tax benefit. If you're investing in a bond, you will not get this. So as a contrast, this orange line represent the typical cash flow for a multifamily deal. So before they sell it in final stage, you get typical it's like a 6 to 8%, although from last year, I see actually lower preferred return. So you, usually I put it 7%, right? So, and then when there's also you get the tax benefit in year 1 as well. However, it's not as close as the ATM deal. It's like half of it. And then in year 7, they have a huge sell, and then you get back your money, and then you also realize some return if the market is good, right? So that explains the cash flow distribution over the years. So it's up to you to decide which one works for you. But to me, my thought process is this. So because I am a little bit concerned about the long-term prospect, like 7 years from now, I don't know whether the real estate bubble will burst or not. So I am not that comfortable with the large cash flow at the end, because this is based on the projection, right? So what if 7 years from now, the economy is really bad and the real estate market it tanks, and then we probably cannot get it back. But on the other hand, I'm also very positive about short term, because Fed is printing money, right? It will support the economy. That's why I want to do some investment with short horizon, because then I get my money back, and then I can decide what to reinvest next, right? So for me, I prefer investment that I can get my money back as soon as possible. So that's why this ATM deal appealed to me, because you see that the annualized cash on cash is very high, it's 21%. So very soon you get your money back. You don't have to wait for the one last final sale, which has a lot of uncertainty, right? So other difference, I can talk to you later. But basically, that's the first difference comes from the distribution of the cash flow over the years. Okay, now I need to make a decision where to put my money, right? Cash flow we already talked about. Then we talk about the return, especially risk-adjusted return, and then tax benefit, payback period, risk management, right? So, okay, so when we talk about return, there are a lot of versions of return. So are we talking about the cash on cash return, meaning that you take out the final sell, because the final sell had a lot of uncertainty there, right? So we can put a number there, but how much confidence you have in that number is a question mark, right? So, okay, so one way to look at it is cash on cash return. And then another one is that we calculate the IRR, so internal rate of return. Basically, it tells you every year how much you can get from this investment over the whole investment period. So there are 4 versions of it. So one is unlevered. Unlevered meaning that you don't borrow money. When you leverage, of course, you juice up your return. But on the other hand, you're also taking more risk, right? So then one way to calculate is that, tell me what is the return if you don't use leverage, right? Leverage, of course, will be like multiple of the unlevered return. Second thing is that when you talk about the return, tell me, is it the before tax or after tax? Because a lot of people will not consider the tax benefit. They will think, okay, stock market, okay, sounds very sexy and then give me high return. But if you think about the tax benefit from real estate, if you compare apple to apple, the after tax return, real estate can be very competitive to the stock market. So here I'm just giving you some example, right? So leverage. So ATM, this specific deal, we don't use any leverage. Stock, bond, we assume that you don't use leverage to buy it. But multifamily, usually you borrow 60 to 80% from the bank. That means you can juice up your return. However, you also take on a lot of risk, especially when the time is uncertain. That can be a double-edged sword. Cash on cash return, as I explained, so the ATM deal, analyze the cash on cash is 21%. You can get your money quickly, within 4 years, 5 years, you can get it back. Multifamily, before the final sale, usually it's 6 to 8%, although right now I think it's becoming lower and lower. So it's a sign of late cycle. Stock, you get 1.3% dividend. Treasury, you get 1.6% coupon. Unlevered IRR, right? So before tax, so here is 12%, multifamily is 9%, stock is 11%. So the bond is 1.4. So that's why I said this ATM, when you look at the cash flow, because it's so stable, you would think, oh, that's like a bond. But if you look at the return, of course, it's not the same thing, right? So, and then if you take into the tax benefit that ATM and multifamily receive, you will see, especially for high income people, like all the accredited investors in our investor pool, then here I'm assuming that this investor, their marginal tax benefit is tax rate is 40%. Then you will see a huge jump here because you are getting here is 100% tax benefit in year one. In year one, instead of like at the end of it, because that means you can save your tax payment immediately. So the more cash that you get, the higher return that you have, right? So here you will also see some benefit here, but because you can only get the 50% of tax benefit, here is 100% benefit. That's why there's a difference. For stock, you have to pay either the short-term or long-term gain. This is the ordinary income, so that's even worse. So now when people, a lot of time, they see this 13% IRR from multifamily, remember when they show it to you, this is the lever return, right? So the lever return, because it take on almost 70% of the loan, right? If you strip out that part, the unlevered one is just 9% or 10%, depends on whether you're looking at. So you cannot take this 12% compared to this 13%, say, hey, they are almost the same. No, it's not the same because this one, although it looks like a 1% lower, but the risk, there's no leverage here. You are the first one get compensated. There's no bank ahead of you. Anything goes wrong, you are the first one to get compensated. Here, 70% of the money goes to the bank. What if the real estate market tanks, right? So they cannot pay the mortgage, then the bank takes over and all your money are gone, right? So this, when you do the comparison, just don't look at the return. You have to look at it at the risk-adjusted return comparison basis. So, yep. And then a lot of people also care about when do I get my money back, right? So here I give you the comparison again. So this is the year, and these are for stock market. You don't get your money back, right? So you just invest there, and then you get whatever appreciation there. So start with the simple one, the treasury, right? So every year you get the 1.6% coupon, and then this is 10-year treasury. So 10-year, they give you your principal back, and then, okay, so majority is here. So if you calculate the weighted average, it tells you, okay, imagine you invested 50,000, then on average, you get your money back. Or you should say, I lend it to someone and then I get all this 50,000 back at 9 years, right? So multifamily, same thing, 7%, and then 72. I assume it's sold at year 5, then it gives you 4.3%. It could be longer, right? So it depends on the market because sometimes year 5 is not a good market. So ATM is that, okay, every year you get 21%, and lastly, the 5th year you get 16%. If you do the calculation, the weighted average of this, you ended up with 2.9 years. So that's why I'm into this, because it's low risk, it's counter cycle, and then also I get my money back faster. So your first monthly distribution will be the 4th month after your investment. Then I can use the money to see, okay, at that point, what are the opportunities in the market? Then I can use that money to invest, right? So you get your money back quickly, and then you can reinvest.
Oh, just real quick, yeah, just want adding to the side note. Today, the 10-year treasury just went down to 1.37%. Actually, have talk of maybe the economy isn't recovering as quickly as people thought. Or maybe or the inflation we've seen might be transitory. Maybe the Fed is right. So who knows? But yeah, it looks like still in a very uncertain market. It looks like.
Yeah, that's actually a very good point. So this is completely improvised. So I just want to tell you a little bit story. So today when I see the 10-year goes down, and then I immediately call my bank to ask them, because I just had a conversation with them. I said, I want to do the cash out refinance. And then they confirmed that today it actually went down compared to last time I checked. So I said, okay, let me do this one. Why I'm so certain? Because if you guys read my newsletter, like I sent out this Sunday or Saturday, I forget, Sunday probably. So I show you my thought process. So basically, it's a completely like a cost-free arbitrage, right? So I have my mortgage every month. I pay. My current mortgage is 3.25%, right? Okay, now since the housing market like it increased by 20%, and I don't want to sell it because I don't want to pay for all this tax or whatever, right? So, and then also I need to live in some place, right? So if I sell it and then I go buy another one, that defeat the whole purpose because you're buying at a crazy high price, right? So, okay, then if I don't want to sell it, how can I benefit from this 20% increase, right? So one way to do it is cash out refi. So then the key point is that, okay, when you do this cash out refi, now all of a sudden you have some money. If you are just sitting on the bank, there's no point of doing this refi, right? So you have to have some investment that can give you higher return than your refinance cost, right? So then you can use it to invest in some opportunities. But one example will be, what about I invest in ATM, right? So that would be a perfect hedge. Why I say that? Because your mortgage payment is monthly, right? So if you use your cash out money to invest in Bitcoin, yes, you can say, okay, I'm betting on the appreciation. But what about your mortgage? Where does the money to pay those monthly payment, right? So, but if you invest in ATM, yeah, it's not sexy. But every month your paycheck coming in and it's 21% per year, the cost is just the three point something, the refinance cost, right? So there's a delta and it perfectly match every month. And then I left with positive cash flow every month. So why not, right? So just give you some idea. Okay, what else? Okay, so this is too complicated, but I think the main message here is that I compare two portfolio. One is 100% invested in stock market. Another one is a 50% in stock market, 50% in ATM. And then the result you can see, if you invest purely in stock market, you will see the result is very difficult to predict. You have 5%, you lose everything, or you also have some upside for sure. But if you are focusing on the middle part, like a 6% to, I forgot, this is a 13% annualized return, then you have higher chance if you use the green bar. The green bar is the 50% stock, 50% of the ATM. So meaning that by doing the diversification, you can achieve higher risk-adjusted return. And also your downside is protected because if you blend the two, you will never lose money according to the historical data. So these are the risk management. I think we talk about things like that. So basically, we deliberately pick the population that's actually, no matter what, they will use cash, right? So, and then also we chose institutional quality operator. And then also there's no leverage. So from deal design perspective, it's very, very safe. We can also talk about some interesting idea. So I was talking to Henry saying that, okay, so everybody get that. I think we do a good job explaining the recession resistant play for this ATM deal. Everybody get that. They might not like it, but they get that. But some people just think, okay, I want to invest in something with the upside. Does that offer the upside potential here? The answer is yes, but because it's like the future, right? So you don't see it today. If you believe the future, then that will be another additional benefit from it. But in our underwriting, because we are very conservative, we never put any upside into our underwriting. So all the returns do not come into this part. But I do want to share with you, this operator, he actually created like a 12 or 14 companies. His major like companies in tech company. So they have a lot of way to monetize this ATM machine. So long story short, this ATM machine is basically a location contract, right? So they use the location to do a lot of marketing monetization things. So you can see this is the real ATM we invested in, right? So compared to the traditional one, the difference is that you see here a huge video topper. So you can sell a lot of advertisement here. This is branded as Citibank. It has nothing to do with Citibank. Every month, Citibank paid them $200 for this advertisement. And then also there is a camera to capture the high level statistics of the users, and then they can sell it to the research group. And then also you can do a lot of, they also talk to a lot of the charity. So you can do the digital donation here, and then you can also buy gift card here. They also have this called proximity marketing. So basically, when you pass by, they can sense you and they send you promotion saying that, hey, there's a McDonald's like next door, and you get maybe $2 off, and then people will just go and buy something there. So this type of advertisement, McDonald's has to pay them, right? So those are the ways to monetize it. So they already did some beta testing, and they see some place already have generated this type of marketing revenue. But again, I think this is the future. This is not today, right? So today, without considering all this upside potential, regardless if you believe it or not, we already seeing the 21% cash on cash return. So yeah. So yeah, okay. So that's the comparison for our investor.
So I this process check now is almost at the top of the hour. So I just wanted to quickly ask the audience that are still here today right now, if you have any question to ask, and if not, we can just summarize it at the how to invest and how to reach out to us. How does that sound?
Yeah, absolutely. I think so they know if they need something, they can also always reach out to us. So just quickly to go over how to invest, right? So first, we need to have accredited investor. So very simple criteria. If you are single, your earned income has to be 200K, couple is 300K for the past 2 years. Or you can go this net worth standard, it's 1 million, either single or couple. Another thing as a natural person will be if you have a Series 765 or 82 license, then you can also be an accredited investor. the others are for the funds, right? So I don't think this will fit our investors. So how can I prove I am accredited investors? Two ways, very simple. One is go to this website called verifyinvestors.com. So they're very efficient. I think they have a lawyer around the globe. Then you pay it and then submit your W-2. They give you the letters within 2 hours. Or we can provide a template for your CPA to sign. You can also invest using your LLC. As long as you are an accredited investor, your LLC is accredited investor. So what is the minimum amount? 53K, incremental also 53K. Source of the money, all kinds of account that you can use, 7 years period, meaning that you get 84 months cash flow nonstop, starting from the 4th month. So the next step, this is important. So after this call, we will have an exit poll. So it's soft commitment. You don't have any legal commitment at all. So you just show us, okay, we want to know more about that. So if you want to know more, just say yes. We will send you more detail. And then verbal commitment deadline is 10th. And then if you are serious about moving forward, we want to get this accredited investor letter from you. And then you have the opportunity to review all the legal docs and ask us any questions that you want. And the funding deadline is 12. We will wire the money no later than 15 to the sponsor so that we can be part of this batch. And then, sorry, I missed something. So once you review the doc and then we will sign and then approve, then you will just fund it and then we will fund it to the sponsor and then we'll let you know the money already wired to them. And then once they receive it, then we'll be informed. And then 4 months after your investment, then you can get your first check. And then Q1 next year, you will get the K1, which shows that on paper, you lost 53K. So that's how it works.
Okay. So maybe it's like, yeah, let me just go ahead and quickly launch the exit poll and we just take a quick minute to fill out. Maybe you can put up the contact us page.
Oh, okay. Yeah, sure.
And also, anyone have any other questions like to ask us? That would be a great time.
Yep.
So I was about 5 to 10 minutes late. So I'm not sure if you have covered it at the beginning. So you mentioned that the ATM business is in a counter cycle versus the multifamily and the stock market. So I wonder why is that? If you have answered that, you can answer me like after this. And also, yeah, that's basically. And also, I saw that on your website, you're also launching another project for multifamily. So I just wanted to know how much skin in the game you have. Do you invest in this personally? So
yeah. So the second one I can talk about a little bit, and then Henry can add. So yes, our model is co-investing model. So all the deals that you will see, first of all, we need to invest it with our own money. So if it cannot pass our standard, we will not push to our investor for sure. So definitely we will invest in with our money. Henry, do you have anything to add for the?
So for the apartment project, we already closed it. It wasn't a fun. We actually did just a deal, straightforward. We as sponsor, and I personally invested 120,000 in that deal. So right now we don't have active apartment projects right now, and we may form a fund in the future. It may not even be multifamily; it could be a different asset class. We're thinking about other recession-resistant type of investment like self-storage or mobile home park. So ATM is a really good one. So we want to start with this first.
Yeah,
I think he also that.
Oh, and this is a 7-year cycle instead of 5, the projection model.
Yeah, this is a 7-year. The good thing is because they lock in for this long term so that they can do a lot of monetization part of it to capture the upside. The reason is because all this location, let's say their customer is for example, all the McDonald's in New York City are their client, right? So, they're all like a prime location. So use that location, you can do a lot more things. ATM is just provide a stable cash flow, but a lot of things going on like on top of that. So you want to lock in that long-term relationship with this store owner.
Yeah, so I think you also asked about the counter-cyclical part of it.
Oh yeah.
So Yan, you want to start with that, and then I'll add more to it.
Yeah, so at the beginning, we show the data that the demand for cash, regardless which cycle are you in, whether the economy is booming or there's financial crisis, like the gray area or financial crisis, you see the growth rate for the cash is actually very, very high. And in COVID, it's actually to the roof, right? So that's why it's counter cycle. This clearly shows that. Yeah.
Yeah. So there's a lot of factors. I mean, we've seen the mother of all probably recessions, in COVID, and you would think that maybe people are not using ATM or people are just using cashless, but we found that based on this actual transaction data from the fund itself, it actually is doing pretty well. They didn't miss any payments. We can actually see a steady growth in revenue and the number of transactions throughout 20 to 21. So I think that answers that. And also just because of demographics, the people who are using ATM are mostly underbanked and unbanked. People maybe not have enough money to keep a bank account open. So if we are entering into another recession, we think that there actually be more people who could be using this, just like when the federal government is issuing these EBT cards to people for the stimulus check. They give them a card and they can use that card to these ATM machines to pull money out to actually use them.
That's a very good point. Yes, a lot of users are actually the EBT or card holder. Yes, absolutely great point. I missed that. Yeah.
Those are great questions.
Yeah, and also you mentioned two terms like sponsor and operator. I'm not sure.
Oh, they are the same. They are the same. Yes. So meaning that those are the people doing the actual work. So we are just like found out those people, do due diligence, analyze the deal, and then we give them the money. So we are not doing the actual work. We are just having the fun part, which is what we are good at. In terms of like loading cash to the machine, fixing the machine, no, don't count me in.
So the sponsor and operators are the same?
They are the same, yeah.
Oh.
Yeah. Oh, one thing I forgot to mention is that some people worry that, okay, what if the ATM I buy is assigned to a bad location, which does not have a good like a foot traffic compared to other ATMs in the portfolio? Don't worry, because you are getting compensated for this diversified portfolio. So anything happen to a specific location will be diversified away. So yeah, it doesn't matter. Any other questions?
Sorry, so the 53 grand is for a specific ATM instead of like you pull the money so everybody share the profit or the loss?
The 53 is the capital that you invest in the pool, your distribution coming from the whole pool. So it won't be a specific one. And also I want to say that the 53K is not buying just one ATM. It's actually multiple ATM. Yeah.
Okay. Yeah, that's what I thought.
Yes. Yeah. But I think to summarize, we understand their specific business strategy, and they also copied that past success since 2012 to newer market, and we see they grow their portfolio. Question is, do you want to be part of it, and for what reason? Of course, I think that the recession resistant is a good reason, but icing on the cake could be the potential upside. We don't put any projection on that, but if they can actually execute that, that would be a very nice story. And I think this investment is ideal for people who are concerned about the economy in the long term, just want some quick turnaround investment, have great cash flow, have more certainty, a lower risk, and also for the people who has very high tax bracket, want to have great tax benefit, because in this one, your first 50K-ish distribution, you don't pay tax at all. So yeah, that's the great benefit there.
Yeah, and especially if you also actively invest in real estate, and you could actually write off a lot of your
Rental
other
income.
gains, rental income. Yeah, and you could, yeah. So check with your CPA. Maybe there even capital gain, but you definitely check with your CPA. And it's 100% bonus depreciation instead of most multifamily or other real estate, which is about 40 to 50%.
Yeah.
Questions? Great. Well, thank you so much for staying with us and hearing us the story. And we look forward to having you as our investor, or just keep chatting with us. Maybe when I have some other investment down the pipeline that may work for you. Again, so thank you so much again. We'll talk to you guys later.
Thank you. Have a good night.
Bye.
Bye.